Good day. Today we will be discussing Chapter 10, Inventories. In particular, we would like to discuss exercise number 11, Blago Wholesale. So Blago Wholesale Company began its operations on January 1, 20X1, and it currently uses the average cost method in costing its inventory. Management is now contemplating a change to the FIFO method in 20X2 and is interested in determining how such a change will affect net income. In this exercise, we will be comparing the effects of reporting the income statement using the average cost method versus the FIFO method. So to give some context, this question takes into consideration two types of accounting methods for inventory: average cost method and FIFO method. Average cost calculates the average price of total inventory, while FIFO accounts for selling the goods purchased in chronological order. In the FIFO method, older inventories costs are assigned to COGS, while newer inventory costs are assigned to an ending inventory.
The following information is given for Blago Wholesale. We have the final inventory amounts in 20X1 and 20X2 using average cost and FIFO, as well as condensed income statements for both years. Based on the previous information presented, we are required to show what changes will take effect for Blago Wholesale's financial statements given the change in inventory accounting style. So we are given the condensed income statement for Blago Wholesale using the average cost method. And we want to know what are the corresponding effects if we change to the FIFO method. We know that changing inventory accounting method from average cost to FIFO will not have any effect on the sales, so sales is still $1 million. Then, to compute for cost of goods sold in 20X1, we sum the indicated cost of goods sold using average cost method and the final inventory using average cost. $600,000 plus ending inventory of $150,000 to give us $750,000, which gives us our total inventory for 20X1. Now, if we subtract the ending inventory using FIFO method from this total inventory, this will give us $750,000 minus $160,000, which equals $590,000. This is going to be our cost of goods sold using FIFO method. Then, to get gross income, the formula is still the same: sales minus cost of goods sold. This is 1 million minus 590,000 to equal 410,000. Again, inventory does not affect selling, general, and administrative, so this stays the same at 250,000. Finally, net income is gross profit less selling, general, and administrative expenses. 410,000 minus 250,000 equals 160,000. And if we compare this to the net income using the average cost method, the net income using FIFO method appears to be $10,000 higher.
Now to fill in the income statement for 20X2, again we know that the sales will be the same regardless of the inventory accounting method, so that means the sales for 20X2 is $1.2 million. To solve for COGS in 20X2, we have to first account for the adjustment made in the inventory from the previous year. Previously, we solved this to be $10,000. We add this adjustment to the average cost final inventory for 20X2, and this will give us the total inventory for 20X2. That is $720,000 plus $10,000 plus $255,000, which is equal to $985,000, which gives us the total inventory for 20X2. Then we subtract the total inventory minus the inventory using FIFO method, and this will give us the COGS for 20X2 using the FIFO method. So $985,000 minus $270,000 equals $715,000, and this is our COGS using the FIFO method in 20X2. Then we subtract the sales from COGS to get our gross income. Our gross profit will be $1.2 million minus $715, which gives us $485,000. And then, we know that SG&A is not affected and it should stay the same, so this should be $275,000. Then we can finally calculate our net income for 20x2. We take our gross income of $485,000 and subtract our SG&A expenses of $275,000. So after subtracting our SG&A from our gross profit, we get $485,000 minus $275,000 equals $210,000. And that tells us that net income in 20x2 is $5,000 higher if we use FIFO method compared to using the average cost method of inventory. So depending on the objective and audience of the financial statements, it would be beneficial for Blago Wholesale to use the FIFO method when reporting to investors and creditors since it shows a higher net income. However, for the purposes of taxes, Blago Wholesale will probably prefer to use the average cost method so they can lower their income tax expense if that is their goal. In our presentation, we have only highlighted some of the many repercussions the companies and financial statement readers need to keep in mind when it comes to inventory reporting. We hope that this has been an insightful presentation and thank you for listening.